Hey troops, good morning. Today is Saturday, December 16th, and this is our semi-monthly market outlook and economic update video. And first up, please, if you like and value these videos, please like and subscribe to our channel right here using those little buttons so that you can continue to receive content pushed to your email address as it is released. Last week, we had an email newsletter go out suggesting that our economic winter may be starting to warm. And with the Feds recently suggesting they might be done with raising interest rates for now, and possibly even looking at reducing rates, we've seen the market hit some of the highest levels since fall of 2021. It's possible that we are closer to the end of the struggle than the beginning, and some folks who can tolerate the volatility may want to start breaking out of some of the conservative positions they have and adding some opportunistic holdings if you can tolerate the volatility and if that is in line with your investment objectives. We've discussed in the past that when interest rates level off and drop, we should consider changing to high-quality bonds as our next potential move out of cash. In fact, we don't want to wait for rates to drop because the bond market anticipates all of this and gets ahead of it. Since October until now, a money market fund, a generic money market fund, has turned in less than 1% for that period, whereas in the same period, the core bond category has turned in closer to 7.6. So it's looking like the bond market is anticipating the next move, and it might be time for us to start making some adjustments. But let's be cautious here. There are still a number of systemic risks out there that I will address in just a moment, and we may have a ways to go before we turn to anything that looks like business as usual. I'm encouraged by the recent market lifting, but let's remember that all that has really happened is that markets have returned to the level that they were about 2 years ago, and we've had a lot of noise and volatility along the way to get here. I'm hopeful that things are getting better, but I'm also wary of the challenges we still face. We'll dig into that and more in just a second. And of course, as always, if you would like to discuss in more detail, please reach out. Now, before we get to the market update and economic outlook part, I want to address a little concern that popped up recently. Recently, there was an unauthorized, scandalous book by Mr. Rob Copeland from the New York Times alleging all sorts of shenanigans at Bridgewater Associates. And as you know, I'm a big fan and Padawan learner of Mr. Ray Dalio, founder of Bridgewater Associates and author of the book, The Big Debt Crisis, The Changing World Order, and Principles. And I'm not going to address the shenanigans part. You can look that up for yourself, but I will share with you Mr. Dalio's response on LinkedIn. And he writes, the book should be taken for what it is, which is another one of those sensational and inaccurate tabloid books written to sell books to people who like gossip. Like all such books, there is a backstory behind it. In brief, the author applied for a job at Bridgewater and was rejected. He then became an investigative reporter at a prominent newspaper and made a career of writing distorted stories about Bridgewater, at first in articles and now in this book. He did this by speaking with former employees who had been dismissed, seeking out negative rumors and bending these into false narratives. Since he had no direct contact with the persons in question, he obviously took the tidbits he got from others and made up the descriptions of what happened to suit his objective. In fact, the author states in the preface of the book that it is filled with made-up dialogue, and he shows in the endnotes that many statements he makes about what happened were said to be untrue by the very people he describes. Bridgewater obviously is not and was not as he describes it. If it were, it wouldn't have had so many happy employees who have stayed so long. It wouldn't have been such great client loyalty and longevity. Friends, I think that will be the end of that. I will continue to use Mr. Dalio's research and comments, and you can feel free to accept it or dismiss it as you see fit. Let's talk about what's going on right now. Clearly, the world is on fire, and it's getting worse, not better. I have great concerns, as you do, that the outbreak of war between Israel and Hamas is likely to expand. Iran wants the war to expand. They want Hezbollah to get involved. This is their golden jihad. They would love to drag the United States into conflict in the Middle East. And already we have seen multiple drone attacks from Yemen against American bases and assets. Thank goodness for the United States Navy destroyer USS Carney was in the region to shoot most of them down. But just a few days ago, 3 commercial ships were hit by missile attacks, and it seems the U.S. warships were targeted also. Iran and others are trying to provoke the U.S. into a greater conflict by attacking the U.S. and other military assets. Did you know there have been at least 75 attacks on U.S. military forces in the region since October 7th? Jamie Dimon, head honcho at JP Morgan, says this is the most dangerous time the world has seen in decades and warns that geopolitical pressures could trigger a deep recession. Elon Musk fears the world is walking foolishly into World War III. And Ray Dalio observes that this is all just another step towards international war. Obviously, all of this piled on top of the Ukraine war, which has already lasted for longer than anyone would have anticipated, tilts everything closer towards greater global conflict. On the plus side, Mr. Dalio credits President Biden in his recent dinner meeting with Xi Jinping as a good step towards reducing global tensions, and in particular with China, and that perhaps the risk of conflict has been reduced by a notch or two. In spite of this increasing global conflict, which many, including myself, would have thought would trigger a downturn in investments, the S&P 500 instead has seen the best rally since 2020. Mostly this is related to the thoughts that the Feds will pause rising interest rates for now, although there's still a 40 to 60% chance priced into the market of a rate hike sometime in mid to late springtime of 2024. Inflation still remains uncomfortably high at around 3.2%, with the Fed's stated target of 2%. We have a little ways to go. But we are starting also to feel the effects of interest rate hikes in the economy. Remember, it takes 6 to 9 months for an interest rate increase to be felt in the economy. Maersk Shipping recently laid off 10,000 workers and issued guidance saying their profits are expected to be lower. This is a big deal because Maersk is the front end of the supply chain, and they are a bellwether for global trade, and it was facing subdued demand on inflationary pressures. America's trucking industry is also in dire states, which is bad news for the American economy because it also serves as an indicator of the mood of consumers and their pocketbooks as they head into the holiday season. While America's economy may still be on a sugar rush, Canada's economy is starting to sour, and China's economy shows signs of strain also. But still, the most predicted recession in history is mysteriously absent. Much of this has to do with the resilience of the American consumer. And last month, we learned that GDP grew at 4.9% annual rate, and consumers keep spending despite high prices and gloomy outlook. But post-pandemic savings are now dwindling, and the American consumer has racked up historically high levels of consumer debt, now over $1 trillion, highest ever. Chris Watling, chief executive at Longview Economics, feels the U.S. consumer is walking towards a cliff, in large part because credit card delinquencies are now on an upswing. Americans are falling behind on auto payments at a record pace. This may be a sign of worse times to come. So why am I telling you all this doom and gloom when the S&P 500 has seen the best November rally ever? Let me introduce you to the Magnificent Seven. These are the 7 stocks. Large technology companies such as Microsoft, Alphabet, Facebook, Nvidia, Tesla. that are driving the return of the S&P 500. They now represent nearly 30% of the capitalization of the S&P 500, which is up from 21% of the capitalization at the end of 2022. Which means the other 493 companies on the S&P 500 might not be doing so hot. Maybe the current rally isn't quite the real thing yet. Maybe the whole thing is being overshadowed and dominated by just these 7 companies. Myself and others believe the recession is not sidelined, it is just delayed. And in fact, as we've mentioned several times, interest rate increases take time to show up in the economy. So now we are only seeing the effect of interest rate increases that took place almost a year ago. Most analysts believe 2024 will be challenging to say the least, and it will be unwise to chase after this stock market rally head fake. Many analysts think this rally looks an awful lot like the 2008 crash and crisis, and that stocks look expensive. And the recession is right around the corner, and we are adjusting to a new normal of high volatility that hasn't really been priced in yet. Fortune magazine writes that there are 5 economic shocks about to hit the U.S. at about the same time next year, including national debt at over $33 trillion, government shutdowns popping in and out of the news all the time, oil headed north of $100 a barrel, labor strikes, whether it's the United Auto Workers or Starbucks. Nearly 44 million student loan borrowers are seeing their loan payments restart, and mortgage rates nearing 8%. But there's one issue that really hasn't been discussed in the media very much that I have my eye on. Here's a question. What do you do with a 45-story skyscraper that has no tenants in it? As we are finding out, you hand it back to the bank and you walk away. Myself and many others believe that there is a massive commercial real estate crisis coming. Just take a look at all the empty buildings in downtown Hartford and multiply that times all the cities in the world, and you have an idea of what's going on. COVID has decimated the way we work. Here is the State House Square food court at lunchtime in downtown Hartford last week. Here we are with the pandemic well behind us, and yet our major American cities and office buildings are closed and devoid of workers. Kevin O'Leary from Shark Tank says no one saw this coming, and the work from home process is now hurting sectors other than real estate. And he is certain that we will see ongoing bank failures as landlords who can no longer lease their buildings simply hand it back to the bank. As we work our way into 2024 and commercial leases are up for renewal, it's likely that we will see a bursting of the commercial real estate bubble, and that's not good. Warren Buffett and many other rich Americans are holding record levels of cash. In fact, as interest rates stabilize, it's probably time for us to stop betting against bonds and get ready for an economic slowdown where bonds may do well. We intend to monitor those trends. I do believe that the first months of 2024 will reveal the additional economic information we need to determine what's next. For now, we believe interest rate increases will slow down but not end. And it's time for us to get used to operating with a T-bill rate at 5.5%. But it is possible to make money in that environment. I think we forget that 5.5% is normal. We ran the United States economy just fine all the way through the 90s and parts of 2000s with rates at that level. We just have to remember how to do it. It will take some time for these issues to work their way through the system, but eventually we will have a return to investable opportunities. In all fairness, there are some positive news points. The rate of inflation appears to be slowing, but does that mean prices are finally decreasing? No, it just means they're going up less rapidly. It also appears the Feds may be coming closer to the end of rising interest rates. But does that mean the cost of doing business will go down? No. Again, it just means the cost of doing business will rise more slowly. I think it's safe to say there may be a glimmer of hope at the end of the tunnel. I think it's safe to say we are closer to the beginning of the end of the hard part. I think there's a little ways to go before it's returned to business as usual. I think spring will be difficult. 2024 will have continued volatility and sideways motion in the markets. But I think by summertime and the client dinner time, we will have a lot more data that helps us understand what to do next. Very likely, we will start to transition to less conservative positions like cash and start to embrace high-quality government and corporate bonds that tend to do well in a flat or declining interest rate environment. Stay tuned. More on this to come. Remember, though, I could be wrong. It's possible. And for that reason, I would encourage you to do your own research and temper these comments with your own judgment. I'll be happy to send you my full stack of research on a PDF if you'd like. But for now, as always, thank you for watching and for your continued confidence in what we do. Please feel free to reach out at any time.